A lot of you know Warren Buffett. Some of you may have even read some of his autobiographies. But did you know he got his start in investing by something called the cigar butt? We're going to talk about what the cigar butt strategy is for Warren Buffett, and then how this young man, Brian, has transitioned that idea, that concept into real estate. Brian, thank you for being here, man. What's going on?
Thank you so much for having me, Mike. Yeah, just good old Sunday morning here.
Yeah, what is it, dude? You're 30 years old. You're actually younger than my daughter, so thank you for making me feel old. I appreciate that. What the heck are you doing studying Warren Buffett, man? I mean, isn't he old?
True. So yeah, I guess I'm an old soul too, though, I suppose. So yeah, I'm originally from Denver, Colorado. Still live here actually, although I travel the country full time, flipping houses with a fairly unique strategy that we'll get into. So I went to Cornell University for college, and I actually transferred there from the Community College of Denver. And I was pretty determined to go to Wall Street. I thought that, going to Wall Street meant that you actually have the opportunity to make your own investing decisions. But really, it's more so about being an Excel monkey, as the term goes. So I was not very tech savvy, and that was not much of a desire for me. I really just wanted to study investment opportunities and make my own decisions. So fairly early on, I realized that I would have to essentially self-educate of how to actually be an investor, that the corporate finance classes and the standard college accounting and business courses were not going to get me there, nor were any potential internship or job opportunities either. And quite frankly, I was pretty worried that it would just suck the soul from my body over time, and that I would never circle back to being an investor if I didn't kind of dig my heels in and take the time to self-educate, even if it meant missing out on certain classes or internship opportunities. Even during the summers, I would do more casual internships just to really read books on investing, and unpaid internships at that. And then like on the side, I would just do yard work for people and, silly things just to make some money.
Right.
So yeah, basically I honed in on very similar to what Warren Buffett's cigar butt method was, in terms of investing not necessarily in great companies with enduring business models with moats that, Warren prefers at this point and, has for the last probably, 40 years. But, instead, basically arbitrage opportunities,
Right.
Just things that are irrationally mispriced for systemic reasons, potentially, like institutions being forced to dump shares in certain situations, whatever it can be. A company spins off a smaller division and it's dropped from the index that the larger company was trading in. So now the index funds have to dump the shares indiscriminately of this new company. Just random things like that can create good buying opportunities. So, I was pretty determined to do that. I actually had a professor offer. He was also the owner of a financial planning firm in Ithaca, New York, where Cornell is. And he had offered for me to essentially prove a track record with this strategy for a year, and then he would allow me to manage some of his clients' funds. So this was super excited. He offered it to me on graduation day. And so this was May of 2017. So by May of 2018, it was 1 year into this track record, and the mock account was up by 50% overall. So I was pretty stoked and, thought that he would be too. And I think he was, although for better or worse, and it's a little bit shocking, he never mentioned it to anyone else in his firm that he was kind of working with me during this year and that he was planning on bringing me on board into the firm at the end of the year. So no one else really had heard about me. And essentially, he had misspoke about this whole opportunity that never really existed in the first place. So that's kind of what spurred my change of asset class ultimately into real estate. I wanted control over something. We can get into how that all got started with getting the capital to get started with real estate. But I felt that the stock market strategy was too risky without having, a more institutional backer, you might say. I can't just do this with family and friends money, which was virtually non-existent at the time anyways. Bless you, Mike.
Thank you. Thank you for that. Tried to fight it off. It didn't work. So again, the whole idea of Warren Buffett's cigar butt thing when he got started, and this is really early. This is probably Warren Buffett 70 years ago, right? Reading, Benjamin Graham, I think was the book that he read. And the whole idea is lots of people throw away stocks that, or frankly, assets, we'll just call it assets, that have one or two good puffs left, right? They're not enduring. They're not, they're not going to be something you hold forever, but if the idea is if you could get it, you could pick it up for nothing, hold it for a couple of puffs, you've got a lot of value. So I've heard about 100%. The cigar butts thing for a long time. I've never thought about it. Even after reading your introductory email, I never thought about cigar butts in real estate, but it does make sense, right? Especially, that's essentially what home flippers are doing, right? They're finding an asset that's mispriced because of condition, time, lots of other factors. And they're going in and going, okay, there's one or two good puffs here. Can I fix the issues at hand and generate a profit? So let's talk about that transition. So you got burned by someone who didn't hold their word. You realize that the stock market, you need a deep pool of capital to really make it work. Let's talk about real estate. How did that transition? And, it sounds like you raised some capital. So how'd you do that as a, I don't know, a 25-year-old or 26-year-old?
Yep. Yeah, I was 25 when I purchased the first property. Essentially, I could have done the same strategy and probably raised a similar amount of capital for the stock market asset class versus the real estate asset class. I did not want the unpredictability, though, of the stock market. Essentially, even though I was up 50% for that 1 year, I did a couple trades candidly after that with my personal funds and lost, very insignificant amount of money because I was investing with a very insignificant amount. But nonetheless, I realized that, okay, I cannot bank on every single trade going well. So since I'm going to be getting started, come hell or high water, but with a very small amount of capital, realistically, I need to get predictable returns. So I wanted to be in control of the asset class or the asset. So basically real estate would allow me to have control, and real estate's a very slow moving market compared to stocks. You're not going to get, the occasional flash crash dynamic per se in the housing market. Even, when things started disintegrating midway into 2008, it didn't drop 20% overnight. So you still have a little bit of time to make decisions in real estate versus the stock market as well. So, especially if you're just in it for short-term trades, let's say. So basically, I was reading various articles online about how to acquire real estate essentially below market value. So the standard methods that most flippers will do is they'll track maybe foreclosure lists and reach out to those distressed homeowners. They'll door knock on distressed looking properties. They'll just send out mailers en masse and see who responds. So all of these methods were mildly intriguing to me, but I felt that they would just be super inefficient. And this is not dissing on people that have done extremely well with this strategy. It can work if you have your systems in place. I just was not personally compelled to develop those systems, let's just say. I wanted a more concrete arbitrage and, didn't know what it would take to gear up on a larger scale for these other Dynamics, and, didn't want to reach out to 1,000 people to maybe get one deal, whatever it could be. So I ultimately stumbled across what are known as tax deed auctions, as opposed to tax lien auctions. A lot of people just mix up those terms. And you see people running like guru courses all the time about these tax liens, giving everyone some free advice. The tax lien courses are essentially a scam. The tax lien strategy is virtually worthless for an individual investor. How most of those will work is that you bid down the interest rate return that you're willing to accept as the new owner of the back taxes of the property. And you never realistically are going to end up with the property either. You're not going to get to the point where you'd be able to foreclose on someone to collect the debt that you're owed, because they're going to pay you before it gets to that point. And the way that the auction had transpired, you're realistically only going to get, maybe a 5 to 10% annualized return on your capital from the interest that you're going to be able to charge these owners, because you're getting bid down by institutions. And my whole strategy is to avoid institutional competition. So institutions dominate the tax lien market and to some extent the tax deed market. So the tax deed market, if people know real estate terminology, deed, a deed to the property represents an ownership stake in the property versus a lien, which is a debt against the property. So, just to reiterate, when you're buying a tax lien, which are actually more common across the US than tax liens, more municipalities do the tax lien auctions than the tax deed auctions. You're only buying the tax debt there.
Got it.
The tax deed auctions, you're actually buying the ownership to the property. So once I discovered that, I was researching essentially the state laws for all 50 states in the US to decipher which states actually offer tax deed auction opportunities. And even within that realm, there's certain states with more attractive laws than others based on, let's just say, not allowing post-auction redemption rights. For example, Texas, which would be an attractive state, to me is relatively unattractive because they will typically allow a 2-year redemption period for the former owners. They would have to pay a fairly steep penalty, but realistically, they're not going to pay it. You will end up with the property. So in Texas is better than some states, but you're waiting 2 years, which to me really messes up the annualized return calculation, which is very important to me. It's about the velocity of capital than anything else to some extent. So basically hone in on the states where there would not be these long post-sale redemption periods, and frankly, no.
So after of the 50 states, roughly speaking, how many states have a tax deed process that's intriguing to you? Is it 5? Is it 13? How rich is the soil? Okay.
Yeah, it's probably about 13. I've not tapped into all of the states, but almost all I have. I've done 9 so far with the tax deed strategy, and I've invested in 10 states just overall, but 9. So
I've never done any of this stuff. So lots of these will be stupid questions, I'm sure. But hey, if I have them, I'm sure others do. So what's one of the states where this works? So I can just say this right state. What's one of the states?
New Mexico. All
right. So New Mexico, I'm assuming it's like a lot of these, New Mexico tax organization or whatever publishes a list of properties that are going to sale or auction, I guess. You're going through some online list. You're probably running comps, looking for, discounted cigar butts, right? To go back to Warren Buffett.
Yeah.
You find one of these properties. So, are these online auctions now? Or are they in person on courthouse steps?
Yeah. So this is that's a huge dynamic actually in terms of impacting competition. Like I said, institutions still are in the space, but they're more so going to be on the online side of things. They're not sending a representative to travel all through New Mexico, potentially to come back empty-handed. So they're waiting where they can just bid on their computer and be more efficient with their time. But for me, that's not very efficient because they're going to bid the property up beyond what I was willing to spend. So I might as well not even track the online ones. So New Mexico is one of the states where every county is still done in person, which makes it more attractive than many of these other states. Like I said, I've done 9 so far. Of those 9, many of those states are almost entirely done online at this point. So I might never circle back to a couple of those states at least. And, let's just say in other of those 9 states, 50% or so are being done online, 50% of the counties. These are all done on the county level.
No, totally get it. So again, so how often do counties do tax deed? Is this like once a year? They accumulate once a quarter? Once a year.
Typically, I should say in Texas, not that I do anything there, but they'll do them actually once a month for the larger counties, and other counties it's kind of on an as needed basis. So if it's a more off the beaten path county, maybe 2 to 3 times a year there. But all the states that I've done business in, it's 1 auction per year per county.
Yeah, it makes sense. That's what I've seen historically. So, okay, you get this auction, you got probably 30 days to research properties. Give me a scale. Like when you see the list for New Mexico or whatever county it's in, I mean, is it typically like 12 properties, or are we talking like 1,200 properties?
Yeah, it really depends on the state, which doesn't make a whole lot of sense to me. As you can compare like a 50,000 person county in New Mexico versus Pennsylvania, let's say. And in Pennsylvania, that 50,000 person county might have 2,000 parcels on their original list, which comes out a month before the auction transpires. So, I mean, it's just very intense, and you have to have some systems in place to know how to research that, especially if you're trying to prepare for things all throughout the state.
Right.
In New Mexico, on their original lists, maybe upwards of 200 to 300, but sometimes as small as 20 per county. And it almost seems irrespective of the county's population at times, which is rather bizarre. I don't understand some of these things, to be honest with you. It doesn't make a whole lot of logical sense, but it's just what I notice. So yeah, but essentially I'll start researching properties. This is going to be humorous, but about 1 to 2 days before the auction happens. The reason being is, let's just say in Pennsylvania, where the county list starts out with 2,000 parcels, it will ultimately get whittled down to maybe 100, let's just say. And you don't want to research, 1,900 parcels that you're never even going to have an opportunity to bid on, and also spend your next month working full time for no reason on one single county. So, and I'm tracking these counties all throughout the US all the time. So I'm having to be efficient with how I do this. I don't have a single full-time employee even helping me with the research. So I'm just waiting until the last minute, and I have my own mental models in place where I'll quickly decipher if it's worth traveling to the area. I'll call the county and ask certain questions to, feel out the likelihood that the owners of the properties that I'm still interested in will end up redeeming. So yeah, there's just certain things like that, but I'm obnoxious. I've never met anyone that waits until the last minute quite this much, but on that point, I've never met anyone traveling the country full time, trying to, do so many different states simultaneously, where I could be hopping on a plane just from state to state before I even get back to my hometown of Denver. So, I need to be very efficient with that, to research virtually every auction that's happening in these attractive states.
So again, tax deeds for the audience. This could be all kinds. It could be bare land. It could be all kinds of stuff. So you're just, I'm guessing, only looking, the asset class you're looking at is, I'm guessing, single family homes, or?
No. Yeah, it's almost entirely single family homes. A couple things I've just noticed for myself: the bare land, even if it has decent market value, will tend to get bid up higher because it's viewed as less risky for the investors there. For me, I kind of view it as more risky because it's more unpredictable with resale value.
Yeah, absolutely. It's crazy.
But no, for sure. I think the general thinking there is that you can't get inside the homes before the auctions unless they're clearly abandoned and you're willing to maybe bust through a door. I've never actually personally done that, although I've been tempted at times. But
no breaking in and entering.
Exactly. And a large amount of the homes I buy are actually occupied when I buy them. I kind of have my own niche of going after the nicest properties, let's just say, at these auctions, which tend to be occupied more often than not.
Right.
Most people, they'll stay in their hometown county through the course of, let's say 20 years of doing these annual auctions, and they might never even get an owner occupied property that winds up in one of their sales. So that's how rare it is at the individual county level, which also forces me to travel, continuously all throughout the country. So I'm going after a true needle in the haystack. No one else has really, done this per se that I've talked to, not on as large of a scale. They'll do it maybe in 1 to 2 states and, pick up a couple properties a year that are owner occupied.
So help me play this out. So I've bought a lot of properties over my days, typically investor occupied, or tenant occupied. Some of them in the middle of eviction. So these aren't all happy situations.
Sure.
So you walk up to the house, you now own it. Somebody's living there. You knock on the door, you introduce yourself. What's the conversation like? Are you doing cash for keys? Or you have a lease in your hand? What's going on there?
Yeah, no, it's a good question. It does depend if it was tenant occupied versus owner occupied. Most of these are going to be owner occupied, my experience. And many times they're inheritance cases. Someone inherits a property and they're, not financially savvy whatsoever. Maybe they don't even understand that they have to pay the taxes, even though they're seeing the notices in the mail. I would also say it's typically combined with addiction for someone to lose a house that they will own outright to, a tax sale. So, I'll tell them, hey, you're getting the overage that I paid beyond the minimum bid, which was like the back taxes for 2 to 5 years, depending on the place. So, let's say if I spend 100,000, which is pretty average for me at these auctions, then, you're getting, let's just say 85,000, the county keeps the 15,000 for back taxes. So that will give them a potential sigh of relief, especially if they inherited the property. Even if that's only a fraction of the property's market value, they were not really having a plan. They don't follow the real estate market. They don't know if that's good money or bad money, but I hate to say it, but especially when you combine it with the psychology of addiction, quick cash like that,
how soon do they see that money? You do the auction, the auction closes on a Friday. They get the overage, in this case of 85K. Does that come in like a certified check? Do they got to go to the county to pick it up? I mean, do they got to vacate the property first? I mean, lots
good questions. They don't really have to vacate or anything like that. They could even be simultaneously destroying the property out of spite, but they are still entitled to the overage. So depending on the place, there's different processes, but typically just a phone call to the county treasurer, and the county treasurer will tell them what they need to do. And it's fairly simple. They might just need to file a piece of paper or two at most. It might even automatically be mailed to them if they tell them their mailing address. So it's pretty simple for them most of the time. There's a lot of people that try to start so-called overage businesses where they'll track down these owners and help them get their overage in exchange for, essentially getting a finder's fee. I feel like that's rather ridiculous because just on the surface, it's so simple for these people to get the overage themselves. I feel like, oh yeah, I'll help you get your $100,000 overage, but give me 50K, which is really a pretty common, sales pitch. And then it takes one phone call. I don't know. I guess that works occasionally if you're willing to scam someone like that. And
not okay. Bad karma. Bad karma. We don't do that. Bad karma.
No, exactly. I've never done that.
All right. So I guess I got a lot of questions as we get to the final 10 minutes. So let's just let's fast forward. You've successfully got a property. Let's just say for now you vacated the property. They vacated, or it was vacant when you got it.
Sure. And cash for keys is common that I'll use to get it vacated.
I would totally.
Or free rent for like 6 months in exchange for them helping me get title insurance. I didn't say this yet, but it is worth mentioning. These properties do not come eligible for title insurance no matter what. It has nothing to do with liens being against the property. It has to do with the risk that the former owner or any party of interest, if there is another lien holder that got wiped out from the sale, that they could come back and challenge that they were not properly notified by the county and that the courts could potentially overturn the properties back to these parties. So I'll try to negotiate with these previous owners. Literally I've given up to 8 months of free rent in exchange for them helping me in the legal process that I'll need to do to get title insurance ultimately. So, if there's enough walk-in equity for me on the property, I'll give people indefinite free rent practically, or even pay them significant cash. I've paid as much as $35,000 in cash just to help me get the title insurance.
Love it. Okay. So now you walk into this property again at the auction. I'm assuming it's like most auctions. You got to bring a certified check. You have to have all the capital that day, or at least within 24 hours.
Yeah. It's rather humorous. I'll end up bringing, let's say 15 cashier's checks probably on average to an auction because, you're many times not allowed to leave and come back, or I just don't have a local bank. So I wouldn't have time to leave and come back after the auction. So I'll essentially have to get as precise as possible, but ultimately slightly overpay. And depending on the state, I might never get that money back. Or if I do, it could take numerous months. So that's why, I'm coming with 15 denominations of cashier's checks.
That's hilarious. Yeah. I know a lot of people that bid on typical auctions. That's very common. Right. They get different sizes. It's wild. All right. So you're doing your work. What typical walk-in equity, is it 50%? Is that what you're looking for? You've got to have a healthy margin.
Yeah. I mean, I'm willing to bid up. Well, maybe I should refrain from saying this for any competition that sees this video, but I'm typically willing to bid up fairly high, but I don't need to. So I would say on average, I end up winning a property at maybe long-term average, like 40% of what I could currently sell it for. But then with the additional expenses with closing and everything and title clearing, I, on average, will double my money within about 7 to 9 months. So yeah, very healthy margins. Sometimes that will include doing a gigantic remodel. I've gone as far as to do a $200,000 remodel on a single property before, after clearing title. But yeah, you don't want to. Yeah, that's another thing I will just tell everyone. If you decide to procrastinate with clearing title until after you've done some remodeling, if the former owner catches wind that you've improved the property but have not wiped them out from their ability to contest the sale, there's a good chance that they're going to want to come back and now try to overturn the sale, because they would get that property in its fully fixed condition now, and you're not reimbursed a dime for that. So yeah, just a
be
warning.
Careful. Be careful.
Yeah, always clear the title before you start the remodels.
There you go. There you go. Well, there's so much more to learn here. Again, we've only got the half hour today, but we'll have to do this again. I guess the last big question I want to ask for the audience is, how did you start raising the private money to make this system go? Because you're tying up hundreds of thousands of dollars for 9 months. How'd you start raising?
Okay, so going back to 2018, and my first purchase was ultimately in May of 2019. But I helped my dad sell his house, like my childhood house that I had grown up in 2018. And he had, a little over a couple $100,000 in equity in that property. So that's what he got. And that was essentially our start for investing. That was the only capital that he really had to his name. And my mom did not have any capital either. And those were the two people that, I was basically going to be able to help with this. So it ended up being my dad and me. And we ended up spending $122,000 at the first auction. Spent $5,000 to clear title by working with the former owners strategically on that to do it very quickly, and put another $1,000 into the remodel, the so-called remodel. We fixed a partially collapsed part of the deck and a broken window within $1,000 essentially, and ended up selling it for $235,000 a few months later. So that was a great deal. Truly a fluke first deal. I think people will be a little entertained by this. I was not planning on investing with my dad that day. We were basically doing a father-son road trip, and I wanted to try to buy some land at this auction for maybe like a couple $1,000 and sell it for roughly double that, just to test the strategy. But since my dad so happened to be accompanying me on the trip, he got enthralled. Likewise, I did as well, with this one house. It was the only house in the auction, which you're typically never even going to see a house in an auction. So we were already just very fortunate to be at the right place at the right time. The bidding dynamics worked in our favor, and we got it precisely for our maximum bid. So that basically gave us more capital, and we snowballed that into 10 deals in total with just his capital. And now I've done 40 more with essentially just my capital, but more recently bringing on some other investors, which at this point was surprisingly easy, I must say. It really was, with the extensive track record at this point. It became
that is the whole key. Everybody that wants to raise private money, you got to go get a track record first.
Yeah.
Right. Once you have a track record, money flies at you.
Exactly. I mean, you'll be lucky if you can start with family. And to be honest, my dad never would have invested that sum with me in a million years if he would not have been there to see the house with his own eyes and get his own emotions involved. It never would have happened. So I would say if you can, bring in a family member intimately at the start, or a friend with some capital, but they need to be there. They need to see what you're doing. They need to really understand the process at a deeper level. Don't just tell them to wire you funds, or, hey, just trust me on this. We've been friends for the last 10 years or whatever.
No.
Yeah. And, it would not have worked with my dad in a million years if I would have done that anyways.
Yeah. Well, folks, we're going to have another conversation with Brian. Do me a favor, leave comments below. What questions do you have about tax deed, tax liens, private money, traveling to 13 different states? I've got a whole list of things I want to know. What do you want to know from Brian? Brian, if somebody wanted to reach out or follow you, what's the best way to do that?
Yeah. So like I said, I'm an old soul. I actually don't have a social media presence or even a LinkedIn. I was actually very paranoid for many years that people were going to take this strategy. So I did not even want it on my LinkedIn. So I literally just let my
Don't worry,
LinkedIn
Brian.
lapse.
Most people are lazy.
Yeah.
You don't
Well,
have
yeah.
that trouble.
And I've really realized that at this time. So I'm not afraid. I'm willing to even tell you specific states. Yeah, I'm really not terribly afraid at the moment. So, but feel free to, can I give my phone number on this? As ridiculous as
Whatever.
that
Hey,
sounds.
dude, it's you're an adult. You can do what you want.
I appreciate it, Mike. All right. So 720, that's the Denver area code, 984-7117. And my email is B, and then my last name, Sturgeon, just spelled like the fish, STURGEON .BS, boy Sam at gmail.com. So bsturgeon.bs@gmail.com.
There you go. Brian, you're amazing, man. We'll do this again. I got lots of more questions, folks. Let me know below. What questions should I ask Brian next time? Thanks, bud.
Thank you, Mike.